to our Basic Trading Concepts series. Today's focus is on technical analysis basics. Technical analysis is a popular tool used by many traders to predict future market movements. Let's delve into what it is and how it's used in the trading world. Technical analysis is the study of past market data, primarily price and volume, to forecast future price movements. Unlike fundamental analysis, which looks at intrinsic value, technical analysis focuses on charts and patterns to understand market trends. At the heart of technical analysis are three core principles. First, market action discounts everything. This means that all known market information is reflected in the price. Second, prices move in trends. Technical analysts look for trends to make predictions. And third, history tends to repeat itself. Market psychology influences traders, often leading to recurring patterns in price movements. Technical analysts use various types of charts. The most common are line charts, bar charts, and candlestick charts. Each type provides different insights. For example, candlestick charts are popular for their ability to show the full price action, open, high, low, close, over a specific period. Analyzing trends is a key aspect of technical analysis. An upward trend indicates a bull market, while a downward trend signals a bear market. Sideways or flat trends suggest a lack of clear market direction. For instance, a series of higher highs and higher lows typically indicates an upward trend, suggesting a potential buying opportunity. Support and resistance levels are crucial in technical analysis. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. Resistance is the opposite, a price level where a trend might pause or reverse due to a concentration of selling interest. Identifying these levels helps traders make decisions about entry and exit points. Technical analysts also use various indicators to make more informed trading decisions. Common indicators include moving averages, the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD. These tools help identify momentum, trends, and potential reversal points. For example, a moving average can help smooth out price data to identify a trend direction more clearly. In summary, technical analysis is a powerful tool for traders, offering insights into market psychology and future price movements. While it's not foolproof, it can be a valuable part of a trader's toolkit when combined with other analysis methods. Stay tuned for more insightful topics in our Intermediate Trading Concepts series, where we'll delve deeper into advanced strategies and market trends. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.